I'm Elizabeth Warren, Chair of the Congressional Oversight Panel. I'm here to introduce our November report, Guarantees and Contingent Payments in TARP and Related Programs. When Congress created the Troubled Asset Relief Program in late 2008, it provided Treasury with many different tools to combat the financial crisis. The main one was to permit Treasury to buy bad mortgage assets directly from financial institutions. But Treasury could also guarantee assets. Now, legally, a guarantee is just a promise to stand behind one party's obligation to another, like co-signing for a car loan. One of the biggest guarantees in our country started back during the Great Depression with FDIC insurance. The government guarantees that even if a bank fails, the money on deposit will be repaid. During the recent financial crisis, the federal government dramatically expanded its role as a guarantor. It increased the maximum FDIC guarantee from $100,000 to $250,000. At the same time, it made guaranteed money market funds, which had never been guaranteed before. But it went much further, also guaranteeing new bank debt, that is, backing up banks when they borrowed from investors. And Treasury guaranteed the value of hundreds of billions of dollars in assets from Citigroup and Bank of America, all so that other investors would lend to those struggling companies. Altogether, guarantees have formed the single largest plank of the government's response to the financial crisis. From the taxpayer's perspective, guarantees offer some real advantages. The most important is that guarantees don't cost anything up front. When government agencies agreed to guarantee $300 billion in Citigroup assets in late 2008, the taxpayers paid no immediate price, and it now appears that we could turn a profit from the fees that Citi paid for those guarantees. Also, the low upfront cost allowed Treasury to guarantee an enormous pool of assets. Because they didn't require spending any money, the guarantees weren't capped by the $700 billion that Congress had allocated to TARP. The results were easy to see. By raising FDIC guarantees and guaranteeing money market funds, Treasury protected the assets of millions of families, and it encouraged people to keep their money in banks and in money market funds even when the economy seemed very shaky. Similarly, commercial lenders who would not risk their money in distressed and uncertain markets agreed to put cash into banks after the U.S. government promised to backstop any losses. And the enormous size of the guarantees played a significant role in calming the financial markets last spring. But there have been real costs. Guarantees carry huge risks for taxpayers. The American taxpayer stood behind guarantees of high-risk assets held by institutions that in some cases were potentially insolvent. It was not a guarantee situation that anyone would want to walk into. Not only were the guarantees covering risky assets from shaky banks, if the guaranteed assets had fallen sharply in value, taxpayers could have suffered enormous losses. At its peak, the government was guaranteeing $4.3 trillion of financial assets. That's more than 6 times the total TARP allocation. We were very, very unlikely to lose most of that money, but the exposure was huge. Another important cost of these guarantees is their impact on markets. By limiting the amount of money that investors can lose in a deal, a guarantee distorts prices. For example, investors will pay more for stock in a bank whose assets are guaranteed than for stock in a similar bank that doesn't have the same guarantee. Think, for example, about how this benefits big banks over small banks if the former have guarantees and the latter do not. Guarantees can also encourage lenders to take on bigger risks, knowing that if they win, they keep the benefits, and if they lose, the taxpayer will back up their bad bets. This form of moral hazard can ultimately increase total risks in the marketplace. In addition, the government's broader economic stabilization effort may have signaled an implicit guarantee that the American taxpayer would bear any price and absorb any loss to avert a financial meltdown. For example, the guarantee for money market funds expired on September 18th with almost no fanfare. But some people believe that if times get rough again and money market funds threaten to sink in value below $1 a share, the government will come right back in. Now, money market funds are paying nothing for a government guarantee right now, but the implicit guarantee is unmistakable. The same is true for too big to fail financial institutions and other beneficiaries of government programs. So long as lenders and borrowers believe that an implicit guarantee remains in effect, the market will remain tangled with mispricing, moral hazard, and excess risk-taking. One technical note is worth calling out. After a wide-ranging review of several guarantees, the panel has not identified any significant flaws in Treasury's implementation of the programs. To the contrary, the panel has noted a trend. Over time, Treasury has been more aggressive in safeguarding the taxpayers' money, a move that we applaud. Nonetheless, in light of the extraordinary scale and the risk to the taxpayers that are posed by these guarantees, the panel believes that these programs should be subject to extraordinary transparency. The panel urges Treasury to disclose further details about the rationale behind guarantee programs and whether these programs have achieved their goals. The panel specifically calls out the Citigroup Asset Guarantee, which is the single largest guarantee offered to date, and it strongly urges Treasury to provide regular, detailed disclosures about the status of the assets backing up this guarantee. Now, you can read the full report and offer your own views on our website, cop.senate.gov. The impact of the guarantees that have been offered over the past year really can't be overstated. The magnitude of the intervention in the market has rewritten the basic rules of our financial system. By putting taxpayer money on the line to cover a private company's bad decisions, Treasury has crossed a threshold that has left us in unknown territory. The cost of the moral hazard that accompanies the explicit and implicit guarantees is not easily measured, but it remains a real and significant force in our financial system today.